Right, so now we are going to start discussing IAS1, International Accounting Standard number 1, which deals with the presentation of financial statements. The document is available. It is under content, the same folder where you would have found the conceptual framework. This full document is there as well. Again, it's a lengthy document. We are going to discuss the important parts there, but obviously we cannot go through the whole document. Okay, so I'm going to share it with you again. Right, so now you should see there IAS1, International Accounting Standard number 1. It deals with the presentation of financial statements. Now, before we start with this, I want you to imagine something. Let me just make this a little bigger. We are going to play a little game. It's almost like a kid's game. We are going to play pretend. Many of us aspire to become firemen or policemen or police ladies or an astronaut. But in reality, we are people that want to become accountants, professional financial accountants or management accountants or auditors. So we are going to pretend. We are going to pretend that we are already a professional accountant when we draw up our financial statements. This is what it is all about, presentation of financial statements. How are we going to prepare financial statements that are ready for publication? So we've got to draw up the financial statements, provide the complete set of financial statements to whoever is going to publish it for us and send it out to our current and our existing and potential shareholders, to the revenue service and all other interested parties. So we cannot expect of the entity that's going to do the publication for us to correct our financial statements, right? So we have to be very specific and very accurate in how we describe items. Again, I'm going to use property, plant and equipment as an example because we are going to be discussing that in the third term. We cannot simply go and write or type on the face of our statement of financial position PPE, because the publishers will not know to correct that property, plant and equipment. As you know, PPE nowadays in the COVID-19 pandemic lockdown has got a different meaning as well. So you cannot simply write PPE, you have to write property, plant and equipment, and don't use abbreviations like the little and sign. Type or write the word and, A-N-D, right? So we are going to present the financial statements so that they are ready for publication. Okay, having got that off my mind, let us have a look at the paragraphs that we want to discuss. There are many paragraphs. I've got a list here, 1, 2, 3, 9, 10, 10A, 15. It's a long list. So let's go to paragraph number 1 first. As you can see, again, we've got a table of contents here. It discusses the objective of financial statements, the scope, definitions, financial statements, and so forth. Structure and content, we're going to discuss that. So there's quite a lot that need to be discussed. So let's start with the first paragraph. If I can find it, there we go. So again, we've got the number of the IAS, International Accounting Standard number 1. The title of the document is Presentation of Financial Statements, right? Perhaps I can just again mention what I mentioned on Tuesday. This covers the statement of comprehensive income, the statement of changes in equity, the statement of financial position, as well as the notes. The exception here is that this standard IAS1 does not cover your statement of cash flows. There's a different standard, IAS number 7, that deals with the statement of cash flows. Okay, let me just see if there's a question, a hand up. Was there a hand up? Oh, no, thank you so much. Mr. Boy has typed something in the chat box for us there. Right. So first of all, the objective. What is the objective of this IAS1 standard? They say this standard, in other words, IAS1, prescribes the basis for presentation of general purpose financial statements to ensure comparability. You remember on Tuesday we spoke about that as well. Comparability both with the entity's financial statements of previous periods, in other words, one particular entity, company A, but it's 2016 financial year. You must compare that with the, or you must be able to compare the 2016 year with the 2017 year, or the 2018 year, or the 2019 year, or the 2020 year. But also, like we said on Tuesday, and with the financial statements of other entities. So you must also be able to compare company A for 2020 with company B for 2020 and company C for 2020 and company D or E or F or whatever for 2020. So basically, when it comes to the comparability, same as we've had in the conceptual framework, you must be able to compare apples with apples or oranges with oranges. Different companies from different companies all over the world, but also one specific company, its various financial periods. That paragraph also states it sets out overall requirements for the preparation of financial statements and also guidelines for their structure and minimum requirements for their content. That is actually quite an important little term for us there. Because clearly we can have financial statements that cover hundreds of pages. We do not want that. We want to present the financial position very concise that someone can see it almost like a picture snapshot. Or the same with your with the results of your operations, that someone can interpret it properly. So you do not want hundreds of pages. You want to summarize the financial statements only in maybe 7 or 8 or 10 pages, depending on how long the notes are. So that is why we very often refer to minimum disclosure requirements. You can always disclose more than what is necessary, but you can never disclose less than what is required of you. In paragraph 2, they discuss the scope here. They say an entity shall apply this standard, in other words, IAS1, in preparing and presenting general purpose financial statements in accordance with international financial reporting standards. We'll see a little bit later. We're going to use virtually this same sentence when we create one of our notes, a note that we call the statement of compliance. But we'll talk about that a little bit later. Then also paragraph 3, this is important for us to understand. This also connects with what we've spoken about on Tuesday. They say other IFRS, other international financial reporting standards, set out the recognition, measurement, and disclosure requirements for specific transactions and events. So once again, almost like we had with the conceptual framework, this is a pretty much a generic document. This gives us the general guidelines. But there are other IFRSs like IAS2, which deals with inventories, which then provides us with recognition, measurement, disclosure requirements, and all sorts of other specific transaction and events, but then it relates only to inventories. Or it might be IAS16, which deals with property, plant, and equipment. There it goes further and gives us additional recognition criteria, measurement criteria, disclosure requirements, but only for PPE. Or it might be, let's say, IAS32, which deals with financial instruments. But then it gives us additional recognition, measurement, disclosure requirements, but only for financial instruments, right? So this document, IAS1, is a generic one that provides us with general recognition, measurement, and disclosure requirements. Right. The definitions, there are not many definitions that we haven't discussed yet. We've already spoken about many of these when we discussed the conceptual framework. We've also mentioned on Tuesday that there are certain interpretations issued by the IASB as well. The question of materiality, there again, we've discussed that on Tuesday, so you know exactly what materiality means. So it's when the omission or misstatement of an item has an influence on the economic decisions made by the users of the financial statements. Next paragraph that I'd like us to have a look at, I've made a note here, components of other comprehensive income. So I just want to look at this. We are going to discuss what is meant by a profit and loss and other comprehensive income soon. But here on this page, which is page 7 of IAS1, they provide us with a long list. It goes from A all the way to where? To J. So there are 10 of them. They provide us with 10 possibilities of what is regarded as other comprehensive income. Now, what we have to understand initially, ladies and gentlemen, is that other comprehensive income is not the same as other income. We will discuss other income later on. We're also going to again discuss other comprehensive income. Other income relates to a type of income that is not regarded as revenue, but is an income that has been realized and it is included in our profit and loss. And perhaps you should make a note of this. I think if you can please make a note of this. When it is other income, if you can make a note, ladies and gentlemen, please, other income, it is a type of income that is not regarded as revenue. We'll speak about revenue a little bit later today. So it's an income that is not regarded as revenue, but it has been realized and therefore it forms part of your profit or loss for the year. That is other income, not other comprehensive income, just other income. So other income does form part of your profit or loss for the year. And then we've got this little animal here that they refer to as other comprehensive income. That is a kind of income that does not form part of your profit or loss. There may be many reasons why it doesn't. For instance, it may be that it is a gain on the value of an asset that hasn't been realized. So one possibility is why it's not included in your profit loss is because it hasn't been realized yet. So therefore, other comprehensive income follows after you've calculated the profit or loss for the year. In financial accounting 2, out of this long list, we are only going to encounter 2 kinds of comprehensive income, and I'm going to highlight that for you. The first kind of other comprehensive income that we are going to be encountering is changes in a revaluation surplus. So if you are using a current value method, as we've seen towards the end of the conceptual framework, there is the possibility has been provided for a current value method. Oh my word! I've got people mowing the grass just in front. I hope you can all hear me. It's making a bit of a noise. But anyway, changes in a revaluation surplus, that is the one kind of other comprehensive income that we are going to encounter. The other one is this one in number D, gains and losses from investments in equity instruments designated at fair values through other comprehensive income in accordance with paragraph 5.7.5 of IFRS 9, which deals with financial instruments. So that is a gain or a loss in investments in equity instruments. So what is an equity instrument? You already know that from the work we've done last term. That is the shares in a company. If our company, our entity, owns shares in another company, and those shares increase in value, perhaps I can ask you the question here. If those shares that you've invested in, if they increase in value, right? They increase in value, but you haven't sold those shares yet. Should you recognize that as a profit, part of your profit or loss for the year, if you can just type there yes or no for me. If it has increased in value but you haven't sold it, should you recognize that as a profit? Has it been realized? Yes or no? Type for me. No. Thank you, Patience. No. Nomi. Masibonko. Thank you. You are all correct. No, because you haven't realized the profit yet, you cannot regard it as part of your profit or loss for the year. It might have gained in value by the end of the year, but it might lose that value again before you sell it, right? But clearly you want to show the value of your assets, as we've discussed earlier today. You want to show the value of your assets at a fair value. You want to have a fair presentation. So you do want to increase the value of your asset, but you cannot then regard it as a profit. So therefore we regard it as a gain that has not been realized, and that is what this paragraph refers to. A gain, it's not a profit yet, or a loss from investments in equity instruments, but you haven't realized that gain or that loss yet, right? So the value has increased, but because you haven't sold it yet, it has not been realized. So you cannot include it in your profit or loss for the year. So that is therefore added to your profit or loss for the year before you draw up your statement of changes in equity. So that one, A and D, are the ones that we are going to be discussing, dealing with in financial accounting 2 regarding other comprehensive income. Right, let me just see what else I want to discuss. Just before we get to paragraph 9, let me see. Oh, just that little paragraph, you all know that. The owners of a company are the holders of instruments classified as equity. In other words, your shareholders, either your ordinary shareholders or your preference shareholders. So that is something you already know from last term. So your ordinary shareholders are what are referred to as your pure owners of the company, but the preference shareholders are also part owners of the company. Then I want us to look at paragraph number 9. The purpose of financial statements. Remember, previously we had a look at the purpose of the standard. The first purpose we looked at is the purpose of the standard IAS1. Now we are going to look at the purpose of financial statements. So IAS1 tells us financial statements are a structured representation of the financial position. So clearly that refers to our statement of financial position, as well as the financial performance of an entity. So that will loosely refer us to our statement of profit or loss, or our statement of comprehensive income. So we're looking at a statement that will present or represent the financial position, but also the financial performance of the company. So the objective of financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful. We are again coming back to that term, useful, to a wide range of users in making economic decisions. So that wide range of users we've seen when we discussed the conceptual framework include our existing and potential shareholders, existing and potential lenders, existing and potential creditors, even the employees of a company. They are interested in whether they are working for a company that's not going to go out of business, as well as the revenue service always, right? And then they say to meet this objective, financial statements provide information about what? A company's assets, a company's liabilities, so that we will find in our statement of financial position. Also a company's equity, so we need to provide information about that, so that will be in our statement of changes in equity. Income and expenses, so that will be in the profit and loss part of our statement of comprehensive income, including gains and losses, in other words, gains and losses that have not been realized yet. That will be in the second part of our statement of comprehensive income, which we will discuss later on in more detail. Contributions by and distributions to owners in their capacity as owners. So that we will find in our statement of changes in equity. And then lastly, cash flows. That will be a separate statement, which we call our statement of cash flows, and we're going to only discuss that in the fourth term. I've heard a few sounds. Let me just go to Blackboard. Any questions from the side? I see there Anela Siwa said, are you all pleased? Oh, your connection. Oh, it's something to do with the connection. Can't display videos and share applications right now. Is that the message that you get, Anele? Anele, I guess that is a message that you receive when you're on Blackboard. That just means that, unfortunately, your connection is a little bit slow. It won't affect what you are hearing. You should still be hearing everything. The only thing is, if I show my face or if I show a video, then you might not be able to see that. Possibly you might also not be able to see the document that I'm displaying. I'm sorry about that. That is just one of the things. If your network is slow, then Blackboard automatically prevents. It allows the sound, the audio part to go through, but not the video part. But anyway, like I say, the document is available on Blackboard as well. Then I want us to have a look at paragraph 10. We've already discussed this. What is a complete set of financial statements? It basically consists of 5 items as a minimum. A statement of financial position, a statement of profit or loss, and other comprehensive income. Later on, when we're going to discuss that, we're going to talk about the possibility that you can use a single statement approach or a dual statement approach. You can either have only a statement of profit and loss, or you can have only a complete statement of comprehensive income, which includes your profit and loss, or you can show your profit and loss and your other comprehensive income in 2 different statements. But we'll talk about that soon. I heard a few sounds again. Let me just go there. Anele Siwa, you've got your hand raised. Yes, would you like to ask something? Anele? If you want to ask something, you must just switch on your microphone, please. That little thingy that looks like an old 1930s microphone. You must just unmute your microphone if you want to share audio. No question. Okay, also a statement of changes in equity, a statement of cash flows, which we'll do in the 4th term, and then the notes, which are comprised, we'll talk about that in detail, which comprises the accounting policies and other explanatory information. There are other possibilities as well. We'll discuss that when we get to the specific statements. Then I want us to go to paragraph number 15. Paragraph 15, this deals, well, next number of paragraphs, ladies and gentlemen, deal with the general features of financial statements. The general features. Now, when it comes to the general features of financial statements, there are a number of them. I know how many there are, but I want us to go and have a look. So under the general features, there are, first of all, if you can perhaps make a little note, or if you have printed this document, then maybe just number them. The first general feature of financial statements is called fair presentation and compliance with IFRSs. The second general feature, going to come back to that just now. Let me just see, that was on page 11. The second general feature is going concern. We're just going to briefly look at that again. We've already discussed that on on Tuesday. The next general feature is the accrual basis of accounting. We've discussed that on Tuesday as well. This general feature is materiality and aggregation. We've discussed materiality as well on Tuesday, but now we're going to also look at what effect does it have on aggregation, and in fact, what does aggregation mean whatsoever? The next general feature is offsetting. Offsetting, so we're going to look at what is meant by offsetting. The next general feature is the frequency of reporting. So we're going to have a look at frequency of reporting as well. The next general feature is comparative information. Again, they mentioned minimum there, but we'll talk about that when we get to it. The next general feature is consistency of presentation. Consistency of presentation. How many do we have now? Should be 8, I think. Hopefully I'm correct. So those are what we refer to as the general features of financial statements. So now we're going to discuss them individually. Let's just see if there are any questions. You all have it. There are 8 of them. Okay, today again, mostly theory, but we're going to start putting all of this into practical situations during next week. So the general features: fair presentation and compliance with IFRS. You can have a read through there. They say financial statements shall present fairly the financial position, financial performance, and cash flows of an entity. Fair presentation, and this is interesting because you'll remember on Tuesday we said when we discussed faithful representation, we said we are going to encounter the term fair presentation when we discuss IAS1, but the term fair presentation is not identical to faithful representation. So what is meant by fair presentation? It includes faithful representation, but it includes a few other things as well. So to fairly present the financial affairs of the company, they say fair presentation requires the faithful representation of effects of transactions, other events, and conditions in accordance with the definition of the elements, what we refer to as the definition criteria, as well as the recognition criteria for those elements that we've mentioned in the conceptual framework. The wording there is actually quite interesting, because I don't know if you've actually seen an external auditor's report. In an external auditor's report, once they've completed the auditor's the actual audit, they have to report on that, right? So they've got to write an auditor's report. And the wording in that auditor's report will be something to the effect that I'm going to say now. They will say, in our opinion, well, they'll start off by saying, we have performed procedures to satisfy us that we can provide an opinion, and we've done all sorts of actions, and we've looked at all sorts of documents to be able to come to our conclusions. But then eventually they will say in the report, in our opinion, the financial statements are a fair presentation. Then they also use that word, a fair presentation of the company's financial position, the company's financial performance, and their cash flows for that particular year. So those words are actually used in an auditor's report as well. Compliance with IFRS, we are going to look at that just now. It also means that we have used the international financial reporting standards in order to draft our financial statements. In paragraph 16, this is quite important for us to read, because I want you to make a little note here. They say an entity whose financial statements comply with IFRS's shall make an explicit and unreserved statement of such compliance in the notes. An entity shall not describe financial statements as complying with IFRSs unless they comply with all the requirements of IFRSs. Now, clearly, in our academic institution, we are going to teach you to comply with all the IFRSs. This is the whole point. Okay, so that means we have to make an explicit and unreserved statement to that effect. So, ladies and gentlemen, make a little note here. When we are going to start doing the notes to the financial statements, which we'll either discuss later today or possibly tomorrow, when we look at the notes to the financial statements, the very first note, before we explain anything else, our first note is going to be a note that does exactly this. So make a note there. We're going to call our first note the statement. We're going to call the note the statement of, not the word such, but then compliance. So we're going to call it the statement of compliance. So please, ladies and gentlemen, statement of compliance. That is our first note. And in that note, we're going to discuss it later again. In that note, we are simply going to state the fact that the financial statements, the annual financial statements, have been drawn up or have been compiled in accordance with the International Financial Reporting Standards. Here we can see it's a requirement of IAS1, so clearly we must make that statement, but only if we do comply with IFRS, which we will. The next paragraph, paragraph 16, that was paragraph 16. The next one I want us to look at is paragraph number 19. They say in paragraph 19, in the extremely rare circumstances. So this doesn't happen often. I can tell you in my quarter of a century as a practicing accountant, I never found a situation that we had to do this. But IAS1 just gives us the possibility that this may happen. But like I say, you might go through your entire profession as an accountant and never encounter this. But they do give us the possibility. They say in the extremely rare circumstances in which management concludes that compliance with the requirement of the IFRS, in other words, if they follow the IFRSs, would be so misleading that it would conflict with the objective of financial statements set out in the conceptual framework. What is the objective? It must be useful, right? So in other words, if the compliance with the IFRS makes the financial statement so misleading, so ambiguous, that it is not useful to the users of the financial statements anymore, then the entity shall depart from that requirement, in other words, the requirement of the IFRSs, in a manner set out in paragraph 20, which we will just briefly have a look at just now. Right. If the relevant regulatory framework requires or otherwise does not prohibit such a departure, when they refer to the regulatory framework, that means the laws of that particular country. So if the laws of the particular company prohibits, if it does not allow departure from using the IFRSs, then you cannot do that. But if that country does allow you to depart from or to deviate from using IFRSs, then you may do so, but only if using the IFRSs would make the financial statements so misleading that it is no longer useful to the users of the financial statements. Anyway, like I say, I've never actually encountered that in practice, but it is possible. So let us just see what must happen if we are not going to comply with the IFRSs. What will happen then? Or what must we then additionally disclose? What must we then go and tell the users of the financial statements in addition to what we already are going to disclose in the financial statements? So paragraph 20 there, when an entity departs from a requirement, in other words, if they not follow the letter of the law in that specific international financial reporting standards, in accordance with that previous paragraph, then that company must disclose a few additional things. They must also then disclose the fact that management has concluded that the financial statements present fairly the entity's financial position, financial performance, and cash flows. Now, for me, that is stating the obvious, because whether they are departing from the IFRSs or not, they are going to state that in any case. Okay, so in the case of paragraph A, they're always going to state that. But now, when they have departed from a requirement in the IFRS, what additionally must they disclose? Then they also must then disclose that it has complied with the applicable IFRSs. In other words, in all other respects, we have, as a company, we have complied with the IFRSs, except that it has departed from one particular requirement in order to achieve fair presentation. Right. So then we are going to still say, yes, we have complied with IFRSs, but we are going to use that little word. This is also a very popular word in the auditor's report. So we're going to say we have complied with the IFRSs, except for one specific item in one IFRS, or maybe two, that we feel that we had to not use the requirements in order to make the financial statements more understandable or more useful. In other words, to achieve a fair presentation. So we have to state the fact that we have used IFRSs except for one particular one, or one particular requirement in one. Then we must also go and disclose what is the title of the IFRS. For instance, IFRS 1 or IFRS 7, which deals with, let's say, financial instruments, or IAS 32, which deals with this, or whatever. The title of that particular standard from which the entity has departed, how we have departed from it, in other words, the nature of the department, including the treatment that the IFRS would require, the reason why the treatment would be so misleading in the circumstance that it would conflict with the objective of financial statements, in other words, the usefulness of it, and then also the actual treatment that we have adopted. So that needs to be disclosed additionally. Also then, for each period presented, the financial effect of the departure on each item in the financial statements that would have been reported in complying with the requirement. So what would the effect be if we had used the IFRS? Right, and that should also then explain basically why it is misleading. Right, so the whole point here is that we, unless the law prohibits it, we can depart from IFRS if we feel that it will make the financial statements clearer, more understandable, ultimately more useful to the users of the financial statements. Just briefly, I'd like us to look at paragraphs 25 and 27. 25 we've already discussed yesterday. Not yesterday, Tuesday, I should say, going concern. We know that going concern means that a company is going to carry on trading into the foreseeable future as it has in the past. We've already discussed on Tuesday, as well as earlier today, that if a company is not a going concern, in other words, if it's going to be liquidated or if they're going to stop trading, then we should perhaps use a different measurement basis for their assets and liabilities. Then we are rather going to look at the so-called liquidation values, or the fair values, what we can sell it for, rather than what the value in use will be. In other words, what the future economic benefits of using that asset into the future will mean to us. So we know what a going concern is. Accrual basis of accounting, paragraph 27, just briefly. You all know what the accrual basis is now, because we've discussed that on Tuesday. It means you are recording a transaction and event when it takes place, when it happens, when it occurs, and not when the money for it flow. So if you are doing a credit sale today and the debtor only needs to pay in a month's time, you record that sale today. Or if you're purchasing from a supplier today and you only need to pay them in 3 months' time, you're going to record the purchase today, not when you pay for it, right? We've discussed that. We've also discussed materiality. We had that silly example of mine of the dog food, but I guess you all understand now what materiality means. So let's now maybe just talk about aggregation. And how does materiality fit in with aggregation? I don't want to spend too much time on this, but I still want you to understand what is meant by aggregation and also what the link between aggregation and materiality is. Aggregation, ladies and gentlemen, again, perhaps you can just take a little note there. Aggregation comes from the word aggregate. And aggregate simply means you are adding a few things together. So if you calculate an aggregate, it means you're adding a lot of things up, right? So aggregation means you are combining certain items with one another. The opposite of aggregation, there are actually two terms being used as the opposite of aggregation. Perhaps you can just write them down as well. The opposite of aggregation, or the two words that they use as opposites, the one is disaggregation. So you just add the 3 letters DIS to the front, disaggregation. Another term they sometimes use for the opposite of aggregation is segregation. So then you spell it SE, and then instead of the first AG, SE, and then gregation again. Okay, so segregation or disaggregation. So segregation or disaggregation is where you take a total and then you split it up into various components. Perhaps we can just use a few examples here again. In the case of property, plant, and equipment, we've already said when you present it on the face of your statement of financial position, you're just going to have one line item, property, plant, and equipment. But then in your notes, where you have to disclose more information, you're going to disaggregate or segregate that particular figure. So you're now going to say, what does it consist of? It consists of the carrying amount, let's say, for motor vehicles, X, the carrying amount for plant, A, or Y or Z or whatever, the carrying amount for property. So you're going to disaggregate that. Another example that we can use, let's do it the opposite way now. If you are going to design the note for inventory, as you probably know from Financial Accounting 1, you're going to disclose there what is your raw material balance, what is your work in progress balance, what is your finished goods balance. You're also going to disclose consumable stores, but on the face of your statement of financial position, now you're going to aggregate them. In other words, you are going to combine them. You're going to show one total for your raw materials and work in progress and finished goods and consumable stores. In other words, you combine them, then you aggregate them, and you're only going to show one total for inventories on the face of your statement of financial position. Now, what is the link between materiality and aggregation? We said the other day that on Tuesday that materiality means that an item is so insignificant that it is not going to change your mind. It is not going to change any economic decision that you have made prior to seeing that figure. So if an amount is so small that it is not going to have any use to the readers or the users of the financial statements, then you can aggregate it with something else, with another item that you disclose on the face or in the notes to your financial statements. Let's perhaps just think of one example there. Now, as we know, we're mostly making use of electronic mail or email. We can attach various kinds of attachments. We can attach Word documents and PDF files and all sorts of documents. So we are using email much more than we are using so-called snail mail. email. In the old days, you had to go to the post office and you had to mail a letter. Nowadays, that doesn't happen so much. It might happen a few times a month, but not like 50 times a day anymore. So your postages might be a very small little cost. So let's say, for instance, this company's generally all their expenses are running into millions of rands. And here you've got postages of, let's say, 10,000 rands. Now that 10,000 rands is insignificant in relation to all the other expenses which are all running into millions of rands. So because your postages is immaterial, it's not material, you might as well go and aggregate it because it's not significant with some other expense. So you might call your internet charges and your ISP fees, which might be much more material amount. You just add that together. You just add your ISP fees and your internet fees together with your postages, and you call it communication cost or whatever you want to call it, right? So that small immaterial amount, you aggregate it with something else instead of showing a very immaterial or insignificant amount of its own in the financial statements. The next paragraph I'd like us to look at is paragraph number 32, which deals with offsetting. So that is another general feature, offsetting. So let us just read the first paragraph, and then it'll be time for us to make a few notes again. They say an entity shall not offset assets and liabilities or income and expenses unless either required by the IFRS, there are certain times where it is required, or when it is permitted by an international financial reporting standards. So this deals with setting off liability against assets or expenses against income. So let's maybe just have a few examples there. You all know from Financial Accounting 1, if you dispose of a non-current asset, are you going to disclose in the financial statements the proceeds on disposal less your carrying amount equals your profit on disposal, or are you only going to disclose the profit on disposal? You can perhaps just type for me just profit or all of it. Type for me something like that. Everything I said, all I said, or just the profit? The profit on the disposal of a non-current asset. Only that or all of it? Only the profit, or are you going to disclose the proceeds on disposal minus the carrying amount and so forth? The truth is you only need to disclose the actual profit on disposal. You don't have to disclose how you calculated the profit on disposal. So that is an example of offsetting, right? An example of offsetting. You already offset the carrying value of the asset against the proceeds. Let's think perhaps of another an example where offsetting is not allowed. Are you allowed to start? I know we haven't discussed the statement of comprehensive income yet, but are you simply allowed to start your statement of comprehensive income with the term gross profit? Yes or no? Just type for me yes or no. Can you start with gross profit, or do you have to start somewhere before that? Yes or no? Quite correct, Naomi? No, you are not, because if you are going to start, thank you, Marcy Bonko, no, you cannot simply start with gross profit, because the gross profit includes certain other amounts that are disclosable. When we are going to discuss the statement of comprehensive income, we'll see that revenue is a disclosable item. You have to disclose revenue on the face of your state of comprehensive income. The same with cost of sales. Cost of sales, as we'll see later on, is one of the cost functions that needs to be disclosed on the face of your statement of comprehensive income. So you cannot simply show the gross profit, because that means you have offset your cost of sales against your revenue, and you are not disclosing either of them, right? So that kind of offsetting is not permitted by the IFRS, simply because the components of gross profit is actually, or they are actually, all disclosable items. What other example can I mention? When it comes to debtors and creditors, we've recently done taxation matters of a company. So let's say, for instance, the revenue service owes you money for value-added tax, so they must give you a refund, and you owe them money for income tax. Are you allowed to offset that against one another? The actual answer there is no. You cannot offset any tax that you owe to the revenue service to any tax that they owe to you, simply, as you remember in one of the lessons we've discussed it, simply because of the system that the revenue service uses. If they owe you 2,000 rands and you owe them 20,000 rands, you cannot simply pay them the 10,000 rand difference and then all is settled. Their system works in such a way that they must refund you whatever they owe you. They must refund you the 10,000 rands, and you must pay them the full 20,000 rands for the income tax. So therefore, if you have a situation where you've got current tax payable for income tax, but you've got current tax refundable for value-added tax, you are not allowed to offset them. So you're not allowed to simply show the net amount of 10,000 rands under your current liabilities. You must show them individually. So you have to show under your current liabilities, current tax payable income tax, 20,000 rands, and then under your current assets, you'll have to show current tax refundable value-added tax, 10,000 rand. Right, so you're not allowed to offset the two, because there is no arrangement possible with a revenue service that you just pay the difference. If you do have such an arrangement with some of your other suppliers, who happens to be a supplier and a customer, and you then arrange with that supplier, which is also a customer, that you can only settle the difference, then you can obviously offset those balances. The next paragraph, perhaps I can just pause there. Are there any questions from your side? Students, you are more than welcome to either type it or ask it in person. No questions from your side? Okay. The next paragraph I'd like us to have a look at is paragraph 36. That is the next general feature of financial statements. The next general feature is the frequency of reporting. Now, this is pretty simple. They say an entity shall present a complete set of financial statements. So that means the statement of comprehensive income, changes in equity, financial position, the notes to it, as well as the statement of cash flows, at least annually. At least once a year. There are certain companies who have to present it more than once a year. For instance, companies that are listed on any securities exchange. If a company is listed on a securities exchange like the JSE, the Johannesburg Securities Exchange, or the NYSE, or the LSE, or NASDAQ, or wherever, then there are certain listing requirements which then forces the company to actually also draw up 6 monthly statements. They call it the interim financial statements. So then they've got to draw up interim financial statements after the first 6 months of the financial year. It doesn't need to be externally audited, as well as a set of financial statements for the full year. But at least annually, so if the company is not listed, if it is a private or a state-owned company, or a personal liability company for that matter, any kind of company, if it is not listed, then they only need to draw up financial statements once a year, right? It is possible that there could be longer or shorter periods than a full annual, a full calendar year. For instance, If it's the company's very first year of trading, let's say the company has got a financial year ending on the 31st of December, but they only started trading on the 1st of July that year, then clearly the financial statements will only be for 6 months, right? But normally if the company has got a history of trading, then each financial year will be a full calendar year as well. I also want us to have a look at paragraph 38. So that will be the next general feature, comparative information. So that is our next general feature, comparative information. What is the minimum comparative information? Again, like we always say, you can always provide too much information. You can provide more information than what is required by the IFRS, but you cannot provide less. Okay, you cannot provide less than what is required. Okay, so what does the IFRS require? Specifically IAS1, they say that at the very minimum, you must present one previous financial year's information as well. Perhaps we can have a look at this paragraph here. They say an entity shall present as a minimum 2 statements of financial position, 2 statements of profit and loss and other comprehensive income. It doesn't have to be 2 separate statements. It can simply be 2 separate rows. Okay, so you'll have, not rows, sorry, columns. Not rows, columns. You have one column for, let's say, this financial year, which is 2020, and then the next column for the previous financial year, which is 2019, right? So, but at the very least, you must provide not only this year's financial information, but also one prior year, the most recent year before this year. The only time that you're not going to provide a previous year comparative column is if this is the first year that you're trading and you don't have previous year's figures. Okay, but anyway, at a minimum, 2 years financial information, the current year and the previous year. There are certain situations, you'll learn about this in Financial Accounting 3, where you might have to provide a third year, not only this year's figures, but also last year's figures and the figures for the year before that. That is normally where you either made an error in the previous year's financial statements and you had to correct the error in this year's financial statements, then you have to provide a third column. Or where there was a change in your financial accounting policies during the course of the year, then you might also have to provide 3 columns, current year column and 2 comparative figure columns. But as a minimum, and in Financial Accounting 2, we're not going to do correction of errors or changes in accounting policies yet. You're going to do that in Financial Accounting 3. So we will have a current year column and a comparative column. That's paragraph 38. Then I want us to go to paragraph number 45. That is the next general feature, consistency of presentation. Ladies and gentlemen, this again has to do with comparability. So what they require of us is to be consistent in our accounting policies. So we should be using the same accounting policies from the one year to the next financial year in order for it to be comparable. So therefore, we should consistently present financial statements from the one to the next. However, as we've said on Tuesday as well, it is not impossible to change your accounting policies, but there must be solid reasons for that. So perhaps we can just read paragraph 45, which explains it very well. They say an entity shall retain the presentation and classification of items in the financial statements from one period to the next. Right, so that is simply what we should do. But there might be exceptions. So they carry on this and they say unless it is apparent following is a significant change in the nature of the entity's operation or a review of its financial statements, that another presentation or classification would be more appropriate, having regards to the criteria for the selection and application of accounting policies in IAS 8, or if an IFRS requires a change in presentation. Perhaps we can just use a very, very easy example here. If we look at a car rental company, for instance, such as Avis, their motor vehicles, and perhaps you can type an answer for me there, students, their motor vehicles, they've got a fleet of thousands and thousands of motor vehicles. Those motor vehicles, do they buy and sell it for profit? Yes or no? If you can just type for me there, please. I just want to make sure you're still awake, that I haven't talked you to sleep. Is their intention to buy and sell the motor vehicles at a profit? Yes or no? The answer is no. The intention is to hold it. It's a non-current asset. The intention is to keep those motor vehicles for a long period of time and then to rent it to others. So they're going to rent it to individuals who want to make use of a motor vehicle in Johannesburg or Durban or wherever they are traveling. So normally those motor vehicles will be seen as non-current assets. And that should always be seen as non-current assets from the one year to the next. But let's say Avis this year, they decide they are no longer going to rent motor vehicles to others. From this year, they're going to buy and sell motor vehicles for profit. So now they're going to become a motor vehicle dealer. They're not renting it out anymore. They now want to be a dealer. So those motor vehicles, should it then still be seen as non-current assets? Yes or no? Should it then still be seen as non-current assets if they're going to purchase and sell them in the short term? Yes or no? Should it still be seen as non-current assets? No, you're quite correct, Naomi. Now it's not a non-current asset anymore. Now it is part of their inventory. Right, so the motor vehicles will now be the inventory that they buy and sell for profit. So clearly then there will not be consistency of presentation. But the reason for that is because the nature, let me just highlight that, the nature of the operations has changed, right? So they're not in the renting business anymore. They're now in the buying and selling business. So clearly that is an exception to the rule where they cannot consistently use the same policies as before because the nature of their business has changed. The next paragraph I want us to look at is paragraph 51. Okay, anyway, so those are the general features, the 8 general features, and hopefully you all have a good idea what they mean now. I see we've got about 15 minutes remaining. Let's see how far we get. I think we'll have to have another class tomorrow because next week I want us to start applying this into practical situations. The next paragraph I want us to look at is paragraph 51. This deals with this, perhaps we can just look at this first. This next section deals with the structure and content of your financial statements. So the structure and content. So clearly we'll have a section that deals with the statement of comprehensive income. What must the structure look like? What must it contain? We'll have a section on the statement of financial position. What must the structure look like? What must the content look like? In other words, what must be in there? What must it contain? The same with the statement of changes in equity and the same with the notes. Remember, the notes aren't random little scribblings. It's part of a structure. It's part of the structure and content of your financial statements. So we'll have a section dealing with each of that. But before we get there, there is an overriding section. We find this in paragraph 50. We generally refer to that as the identification matters. What needs to be identified when you draw up your financial statement? So there are certain identification matters. When you are practically sitting there as a financial accountant, you are now practicing as one. What do you need to identify when you draw up the financial statements? So here in paragraph 51, they give us a complete list of what needs to be identified. First of all, the name of the reporting entity. So at the top of our financial statements, if our company's name is ABC Limited, we are going to tell the readers there, this is ABC Limited. So the name of our company. There's something that I just want to find as well. Perhaps you can just add a little note there. I don't see it here. Perhaps it's in the first, yeah, it's in the first paragraph. The entity, or first part of paragraph 51, an entity shall clearly identify each financial assets and the notes. That's actually the first one. So we are going to identify the name of the reporting entity, very importantly. So at the top, we're going to write the name of the company that we are drawing up the financial statements for. And then also we must clearly identify each financial statement and the notes. So there we are. After we've identified the name of the reporting entity, we're going to identify each statement. So we're going to say this page is the statement of, let's say, comprehensive income. Next page, we're going to identify that statement. This is the statement of changes in equity. And then next page, we're going to say this is the statement of financial position. And next page, this is the statement of cash flows. You get the idea. Next few pages, these are the notes to the financial statements. So besides identifying the name of the reporting entity, we must also clearly identify each financial statement, including the notes. Paragraph B, you don't need to worry too much about, but I'm just going to briefly explain it. You must also state whether the financial statements are of an individual entity or a group of entities. That is where we have a group structure, which you are not going to find in financial accounting 2. We'll only cover that at a later level. Sometimes one company owns the majority of shares in another company. Then we refer to that company that holds more than 50% of the shares in another company. We call it the holding company or the mother company. And the company that it holds the shares in is called the subsidiary company. Anyway, if there is a structure like that where one company owns more than 50%, they in effect control the other company, then we say there is a group structure, right? Then that holding company must not only present their own financial statements, they must, of that individual entity, they must also produce something we refer to as consolidated financial statements. In other words, they must then aggregate and combine the results and the financial of the group as a whole. But anyway, like I say, you don't need to, you won't encounter that in financial accounting 2. But just remember, for future reference, you must distinguish and clearly identify whether it's the financial statements of that individual company or whether it's the financial statement of the group as a whole. Then thirdly, C, you must clearly identify the date of the end of the reporting period or the period covered by the set of financial statements or notes. So let's maybe think about the statement of comprehensive income. The statement of comprehensive income, does that provide us with a total of transaction and events that happened over a period of time, or is it a picture snapshot at a specific point in time? In the case of the statement of comprehensive income, it is the aggregate or the sum total of various transactions and events that took place during the financial year. So when we identify it, we're going to identify it as the statement of comprehensive income for the year ended. So it's a whole reporting period, not the end, but the period, the whole period covered. So the statement of comprehensive income for the year ended, let's say 28th of February 2019 or whatever the case may be. Similar with your statement of changes in equity. The statement of changes in equity, as you know, is a reconciliation between your opening balances of equity with your closing balances of equity. In other words, the intervening part, your reconciling items, that represents the movement in equity during the course of the year. So again, it covers a period. So you will call that statement your statement of changes in equity for the year ended, let's say 28th of February 2019. In the case of your statement, the same, by the way, also with your statement of cash flows, it's your cash flows for the period, so for a full year. But in the case of your statement of financial position, it does not provide you with events and transactions that happen during the course of the year. It is a picture. It's like you're taking a photograph, your camera, or with your phone, the camera in your phone. You're taking a picture snapshot on a specific date of what the financial position is. That date, normally a reporting date, like your financial year end. So that is your financial position, and that will be the title of that statement, your statement of financial position, not for the year ended, but that one, the date of the end of the reporting period. So you're going to call it your statement of financial position as at the 28th of February, not the year ended, but as at, right? Like I say, it's almost like a photograph that you're taking of the financial position. You're providing a picture snapshot of the financial position of the company on a specific date. Another thing that must be disclosed, you will have that at the top of each column for your current financial year, as well as your comparative figures, the presentation currency. So in which currency, which world currency are you presenting your financial statements? If your company is registered in South Africa, it will be rand. You will indicate at the top of each column your presentation currency is rand. Or if your company is in the UK, it will be pound. Or if your company is in the United States, it will be the US dollar. Or if it's situated in Japan, it will be yen, whatever the case may be, right? So your presentation currency. And then lastly, just the level of rounding used in presenting amounts in the financial statements. Sometimes you may find that the company is so huge that let's say the revenue consists of 10 or 12 digits. So then you are not going to present, let's say, 10 million rands by what is it? 10 billion rands will be 3, 6, 9, 10, 11 digits. That is too long. Then you're simply going to say, I'm rounding off it to the closest 1,000 rands, or I'm rounding it off to the closest billion rands. But then at the top, just below your reporting currency, if you're rounding it off to the closest 1,000 rands, you'll have, besides your reporting currency, the R, you'll have an apostrophe 000. And that will then indicate to the users of the financial statements that you've rounded off the figure to the closest 1,000 rands. Right. Again, we could possibly bring the concept of materiality in here. It means that 1,000 rands is not material for that company. Okay, so those are your reporting, your identification matters, right? Identification matters for financial statements. So now we have to go and look at the statements, each of them in its own right. So we're going to start with the statement of financial position. Then we are going to look at our statement of comprehensive income. Thereafter, we're going to look at our statement of changes in equity. Then we are going to look at the notes. But ladies and gentlemen, that I think is going to be a full 2-hour session again. So I think it's possibly a good time to quit for the day. But then we'll have to have another session tomorrow. It might not be the full 2 hours. It might be a little less, but it might be two full hours. But I really want us to finish IAS1, the theoretical part, this week. So that means tomorrow. So that on Tuesday, I think next week, Monday is a public holiday, so that on Tuesday, we can start with the practical application of both the conceptual framework and IAS1. So tomorrow we're going to start with a statement of financial position, and we're going to look at all the financial statements except for the statement of cash flows, which we'll do in the fourth term, and we'll see what is required, what must it contain, what is the structure going to be, and so forth. Okay, so it's almost 1 o'clock, ladies and gentlemen. Let us just pause there for a second. Is there any questions from your side? Now is a good time to ask any questions about today's work. I will create a new session for tomorrow then. I will send you the session, those students that are registered on District 6 campus as full-time students. You can just click on the virtual classroom menu item once you've logged onto Blackboard. For students from Wellington campus or part-time students, we're using the full-time website as our host these classes. But I'll send a guest link so that you can join as well. So any questions from your side? No questions? Mr. Borman, do you want to add anything? It looks like we have no choice but to carry on tomorrow.
No questions from my side, Mr. van Rensburg. It was a good class. Thank you very much.
Thank you very much, Mr. Borman. Okay, students, thank you for attending. I did not really expect us to finish everything with regards to IAS1 today, but now we know for a fact that we'll have to have a further follow-up class tomorrow. So I'll send out the link. It will again start at 11 o'clock. Unless you want to start earlier, but 11 o'clock is a good time for somebody who wants to go and do something early in the morning and also wants to still do something in the afternoon. Bradley Biswapi, dankie meneer. You're most welcome. It is a groot plesier. It is a pleasure dealing with you students. It always is. It always has been. So you are more than welcome. Thank you, Bradley. Right, ladies and gentlemen, I'm going to stop recording.